My dear traders, today is Tuesday, September 21st, and let me share a fresh market review prepared for InstaForex. The London Bullion Market Association of LBMA, which is the independent precious market authority, predicted last year that gold would cost $2,000 per troy ounce in the autumn of 2021. In the meantime, the metal is trading at nearly $1,762 with bearish prospects. Recently, experts at the LBMA have downgraded their forecast, expecting the price at $1,969 by the year end. In fact, this is ridiculous because they make their forecasts at random. What other interesting events have happened? Bitcoin has dropped in value. It has completed the third downward wave, with the spike propelled by the news from El Salvador. When analysts make their forecast, they should justify their projection by something. The crypto market is no exception. A lot of Western analysts share their viewpoint that the slump could be somehow related to the debt crisis of one of the largest construction companies in China. They call it a slump, but I think this is a usual price development. Perhaps analysts want to attract attention to their articles this way. Personally, I don't see any connection between the debt crisis in Evergrande Group and the fall in Bitcoin price. Some analysts make even deeper conclusions, saying that a fall of the gold price and Bitcoin and the S&P 500 index has happened for the same reason. This is a nightmare. Analysts are racking their brains trying to connect the things which are not related at all, either from technical or fundamental points. Commonly, we begin our discussion with gold. I have a simple old trading idea for gold. I stick to my method hunting for stop orders, which I actively exploit and promote among my fellow traders. Today, I turned your attention to the level of $1,766. I suggest that we could trade upwards. Why? On the daily and 1 hour charts, we see the double top pattern at highs. We see that stop orders at lows have been activated, but stop orders set by sellers have not been triggered yet in the last 2 days. Hence, all traders who rush to sell gold after its slump can set stop losses at Friday's and Monday's levels. This is an excellent target for market makers to push the price to trigger stop orders of these unlucky traders. My advice is either to trade upwards or not to sell with a stop loss behind this zone, because you are running a risk of making losses. I feel committed to warn you against these losses. Technically, I suggest using the buyer pressure, which started yesterday in the Asian trade and finished in the American trade. My idea is to use this impulse as a basis and apply the Fibonacci grid. We could try an opening long position from 61% or 50% Fibonacci levels. Take profit could be above Friday's night. This is 1,1766. Let me remind you that the key event this week will be the Fed's policy meeting. The decisions will be unveiled and commented on Wednesday at the press conference. The market will see 2 waves of volatility. My aim is to understand where traders will hide their stop losses and hunt for them using my methods. My plan is that the gold price action should kick sellers out of the market, and we should earn on this. The euro-dollar pair closed with a pin bar yesterday. I don't know how to comment on this situation. Nothing interesting for a while. The euro left the double top between July and September. We tried to hunt for these from pin bars, but closed positions at the right time after 2 short pin bars. Price action is another of my trading methods. It has proved its efficiency. On the one hand, this is a good level at highs. On the other hand, this is a level at 1-year lows the traders approached in August, so this amplitude measures 300 pips. It would be better not to reach for any correlation between gold and the euro. For example, if gold is falling, then the euro will do the same. You should refer to technical analysis. Currently, the market does not offer any trading opportunities to hunt either for the upper or lower level. I think we should wait for a particular impulse. After the Fed's press conference, we will see the downward pressure, so the level of 1.16 will come under pressure. Then we could hit this level from retracements, activating stop orders of sellers. Alternatively, the Fed might disappoint the market and trigger strong upward pressure. We will set the target at 1.19 and we will attack buyers from retracements. Before the Fed's meeting, nobody will venture into opening large bets. Don't enter the market ahead of the event. Be patient and trade at the right time. The pound sterling. Yesterday I recommended you wait for a retracement. Both the euro and the sterling are under downward pressure. The pound dollar pair has created a clear-cut level of 1.3570, the low of July and August, and September. The price is also creeping towards this level. If the pair makes retracements today and tomorrow, we could try opening short positions at retracements, aiming to sell it at a breakout of the July lows. I remind you that the pound sterling is a trendy instrument, so it can develop a long-lasting trend. It remains at elevated levels for a year. There is a head and shoulders pattern. The pair easily makes price swings of 10,000 pips. That's all I wanted to tell you today. See you online soon. Bye bye.